Hey everyone, this is Kirk here again from Option Alpha, and in this video I want to go through a backtest that we ran on QQQ with a weekly long call strategy. And not only was it a weekly long call strategy, but it was also trading the weekly contracts. So it was a kind of like a double weekly long call strategy. Essentially what we did in running this test, and I'll show you all the parameters here and then we'll kind of go through the results. We ran this test on QQQ. We ran the backtest for all time. The trade frequency was weekly. That's really where this comes in. So we were trading it every single week. So every week the backtester was looking for a new entry. We only had these 3 different allocations here, which were pretty simple, and we can adjust these as we go through this video here, but we did 1% of capital per position, 2%, and 5%. So at any given time, wherever the portfolio was, we would just be allocating 1% of our capital or 2% or 5% to the strategy for buying long call options in the QQQ. For the strategy, you can see we used a long call option. We were buying the 30 deltas. So this is a really common strategy that a lot of people do run, or at least I see out there, where people will buy a slightly out of the money call option. And a lot of people like to use the weekly contracts because they can recycle these over and over again. So they buy a weekly contract, a 30 delta, just a week out, 10 days out till expiration or less. And they try to recycle these contracts really quickly, probably because in many cases they're really cheap, so you can buy a lot of them. And so the idea that we want to test here is, does it really have any validity? Can we really generate a profitable trading strategy while using that? So in this case, we did a 30 delta, but again, you can change these deltas up as much as you want. We did 10 days to go until expiration, no IV rank filters. So minimum IV rank was from 0 to 100, which means that regardless of where implied volatility was, we continued to buy these call options on the QQQ. And then we did have profit taking in here. So this was interesting. We tried to take profits at 25%. So the thought process was, okay, if we do take profits, we want to take them quickly. If we make a trade and something works out really well, maybe we want to take profits early. You could, again, adjust this and do whatever you want. Not take profits if you want to. You could use a stop loss if you want to. And we didn't have any days till expiration. So the idea here was, okay, we're just going to let it go till expiration, win, lose, or draw, see what it ends up working out. We're not going to close it, 5 days early because it's only a 10-day contract anyway, or, somewhere around 10 days. So if it closes early 5 days, we'd only hold it for a little bit. We're not going to close it a day before. We're just going to really try to, churn these weekly contracts. And if they expire out of the money, they expire out of the money. And so be it. So this is the results of running that strategy, the weekly contracts and weekly entries. You can see for all of the allocations that we had, when you ran it from basically 2001, so basically March 2011, and you started with $10,000 in all of the accounts, you can see that pretty much all of the portfolio allocations lost money until about 2018. That's where you actually started to make money on this strategy. And this is what's tough sometimes about running backtests and then the reality of trading through some of these things is that if you see this number here without the context of, the end, the whole history of the trading strategy, the way that we show with all these different lines, you'd say to yourself, oh, well, that was a really profitable strategy and that strategy won. And maybe I should trade this in my account, or maybe you shouldn't trade in your account, or whatever it is. But if you don't have the context of the whole picture of the strategy going back in time, what you don't realize is that for the vast majority of time, basically for 7 years, you lost money on this strategy. And you would have had to continuously pump money into the strategy over and over and over and over again. And so I think that when you use a backtester like this, not only is it helpful just to see what works and what doesn't work and what allocations work or what don't work, but also it gives you an idea of trying to see if this actually was a strategy that you would have stuck with the entire time. How many times did it really test you and give you an opportunity to bail on the strategy? Now, if you would have continued in all of these cases, you would have made money on this strategy long term. I don't know if it would have been an amazing return on your capital and time and investment, but you would have made money on all these strategies long term. They just really picked up in their ability to make money, really from 2018 through 2020. That being said, you spent most of your time underwater on the strategy. And in many cases, kind of at the depths of it, for the 5% allocation, you would have been down 55% on this strategy, still allocating 5% of your account every single time. I don't think reasonably any rational investor would have survived that type of drawdown, or it would have been really, really hard to do. But nevertheless, you can come through here and look at the different allocations and see how it performed. You can see not only the profit metrics, 1%, 2%, 5%, etc., and see how they perform, but you can also see the max drawdowns. And you can see at any given time, this 5% per position size was down 70%. Again, I don't see how a rational investor would have been down 70% and still stuck with it. In fact, most people, if they get down 5 or 6 or 7%, they bail on a strategy even within those small confines. So it's really interesting to see kind of how this allocation worked out and how the strategy performed overall. And again, you can just continue to scroll down and you can see all of the different trades that you would have made. What's interesting about this is, again, the allocation here. This is what I think is very very shiny, I guess, is alluring to people who trade weekly contracts, is the ability to do a lot of contracts and, hopefully hit this like home run out of the park, trade. And so you can see this as reflected here for sure, that the weekly contracts, although cheap and buying the 30 deltas, in many cases, you're able to buy a lot of contracts to fill up your allocation. And that worked out as you got towards the later half, but in the beginning, it didn't work out as well. Some of the best wins and best losses, this was pretty interesting, I thought. So the best win in this case, and this was the 5% allocation, which was the highest, most profitable one at the end of the day. The best win that you had at any one point was $1,600, and the best loss, or the biggest loss that you had, was about $1,000. And so you can see the win rate here was just marginally over 55%. So it was really a trade where you had, a lot of wins, a lot of losses, back to back to back. And so I think it was a tough one to trade, no doubt. All right, so now what we want to do, though, is we want to go in here and we want to change up these capital allocations. We want to try something a little bit different. Now, it's tough here because in this case, you're starting off with a small amount of money for this particular run, but you're also just trading weekly contracts and you're doing it every single week. So you don't have a lot of overlapping trades. So in this case, it's probably best to use different capital allocations here to see what works, a little bit better. We're going to keep that 5% allocation here as kind of the baseline. That 5% again is the orange line here. We're going to keep that as the baseline. And we're going to try to move some of these up and see if we could potentially do a little bit better just allocating our capital a little bit different. So we're going to try a 4% allocation, and then we're actually going to try a 6% allocation and see if actually allocating more, although we know that 5% had a pretty decent drawdown, did it actually perform better? Because maybe out of the gate, it would have done, a little bit better right in the early stages. Maybe would have alleviated some of that drawdown risk. So we just go in here, we just simply redo the allocations, hit run backtest, and then you can see it populates the results here. You can see that these are pretty close together because the allocations are within 1% of each other, but it's really interesting to see that, again, allocating more capital in this case led you to actually losing more money, even though it was a quote-unquote profitable strategy at the end of the day. The allocation that won the most in this case was the 5% allocation, followed by the 4% allocation, and then finally the last place winner was the 6% allocation. So it's really fascinating to see how you can change up these allocations just on the fly. Let's try to do something a little bit more aggressive in this case. Let's try to break this portfolio, see where the breaking point is. Maybe about 10% allocation might potentially have been the breaking point. So we'll try that. We'll try 10%, and we'll try 12. We'll try 15%. That doesn't matter because it's all a back test, and you can just run it really quickly inside of our system. So you click run backtest. All right, and you got your results here, and you can see pretty much that the 10 and 15% portfolios essentially broke down and collapsed. The 5% still survived, obviously. We knew that from before, but you can see what the results were. And it's funny, right out of the gate, if you looked like a genius, the first couple of months trading this strategy, because right at the top here, you can see that the 10% allocation strategy was up about 45%. The 15% allocation strategy was up about 65%. So early on in the cycle, which is very, typical, that happens in many, strategies where you trade, you either look really stupid or really, smart in the beginning, but it's the longevity of the strategy that really matters at the end of the day. And in this case, both of these strategies right out of the gate looked really, really good. So you might have thought to yourself, this is working out well, I'm going to stick with the same allocation. But then both of those strategies obviously collapsed really quickly. For both of those, you had insane maximum losses. The maximum drawdown here essentially collapsed the portfolio. Same thing here, essentially collapsed the portfolio to where it couldn't trade for these two accounts. It's just really, really fascinating to see how allocations really impact the performance of a strategy. It's so different than just looking just at the individual strategy itself, which is why we wanted to build in these allocations to the new backtester that we have here on Option Alpha so that you can test these things and see what works best for your portfolio or what works best for the strategies that you're trading, or just your overall style of trading. If you want to be aggressive or if you want to be really conservative, you can test out all these different things with the backtester. So hopefully this helps out. As always, if you guys enjoy this, let us know, give us a thumbs up, and until next time, happy trading.